Right, so we're talking about risk transfer, and a typical example is insurance. Now you have risk sharing, which is simply collaborating with another person and jointly sharing the risk. A typical example here is business partnerships and joint ventures. Then you also have hedging risk. When you hedge the risk. When you hedge risk, it simply means you are creating a position or making a transaction that offsets an exposure to another risk. So what does this mean? This is all English. So a typical example, if a company has an exposure to currency risk, right? So what is currency risk? The risk that currencies will fluctuate, So the way the Ghana cedi goes up and down like that, that's currency risk. If a company has an exposure to currency risk and will lose money if the US dollar falls in value against the euro, a hedge can be created whereby the company will make a profit if the US dollar falls in value against the euro. The loss on the original risk exposure will be offset by a gain on the hedge position. So what are we saying here? Let me give an example. This seems to be like a very complicated thing, but it's not, right? When you are hedging, it means you are creating a position that offsets an exposure to another risk. So this is what sometimes we do. A typical example of hedging is where you realize that, oh, the cedi will go down against the dollar. It's going down against the dollar. So what do you do to hedge? You go and buy some dollars. Or if you are dealing with a US supplier who maybe supplies goods to you and charges dollars for it, what you do is you enter into an agreement with them to say, hey, let's fix the rates of this, the exchange rates at which I'll buy your goods, so that it doesn't affect me a lot. So when you're hedging, you're protecting yourself against the risk. That's what essentially means. Does that make sense?
Yes, please.
Okay. Now let's move on to risk avoidance. Risk avoidance is avoiding the risk totally, not having any exposure to risk. So when you're doing risk avoidance, it means that if you look at a business and see that this business is risky, what you do is you avoid the business. Simple. You have risk retention, which means accepting the risk with the expectation of making a return. Now, what is the role of management and board of directors in identifying risk? What is their role? We need to know that management is normally responsible for identifying key risk. Management is responsible for identifying key risk. Management is responsible. Management is also responsible for assessing the risk. This same management, they are also responsible for monitoring the risk and the effectiveness of risk control. All these things lie in the bosom of management. But what about the board of directors? We've already stated that the board of directors, they are more into setting the company's policy. They are into policy for risk, and they give clear guidance about the company's risk appetite. They give clear guidance about the company's risk appetite. Very, very key. Very, very key. The UK Corporate Governance Code states, for example, that the board should conduct a review at least once a year of the effectiveness of internal controls. We cannot talk about risk without leaving without talking about internal controls. Without talking about controls. The UK Corporate Governance Code, for example, also requires the board to report to shareholders. So the board has a lot of responsibilities. They set the company's policy for risk, and also they give guidance on the risk appetite, which we've talked about. Then they're also supposed to report to shareholders on its review of internal controls. We need to know that we are talking UK. The requirements of the Ghana Code of Best Practices for Corporate Governance for the Board of Directors are very similar to those of the UK. Now let's move on to monitoring and controlling risk. Any questions so far? Any questions so far? We have an interesting long way to go. Any questions so far?
No, please.
Okay, amazing. Let's talk about risk audits. Risk audits. For those doing audits, you know what auditing is. For those doing strategy, you know what strategy. For those doing strategy, you know what risk is. For those doing audit and strategy, you would know what risk audit is. Now let's talk about risk audits. What is it all about? This is the process or the process of monitoring risk, to ensure that the risk management techniques or tools or strategies you put in place are effective in handling the risk you identified. The purpose of risk monitoring is to ensure that there are processes and procedures for identifying risk and that these are effective. That's how we audit risk. That's why we audit risk. Very, very important. Hey, sorry, but who won the court case? I haven't been following.
Oh, it was dismissed. The petition was dismissed.
Oh, wow. Interesting. So essentially oh, okay, I see. There was no anyway. The purpose of risk monitoring is to ensure that there are internal controls. Like I've always said, when we talk about risk, don't forget about internal controls, please. For those who are doing audits, the knowledge in audit will come in handy. We are trying to ensure the operating effectiveness of the controls, right? So we are trying to see that, these controls, they're operating effectively. They're operating effectively. Very, very important. Very, very important. Okay. The advantage of having risk audits performed by internal auditors or risk management is that individuals who carry out the audits will be very familiar with the company and its systems, procedures, and culture, right? So risk auditors, when it's carried out by internal auditors, because internal auditors understand the business, the processes that go on within the business, that's an advantage. That's an advantage. Now let's look at the 4 stages in risk audits. What are the 4 stages in risk audits? IARR, identification, assessment, review, and report. I've already mentioned that you cannot audit risk or manage risk without identifying risk. What will you be identifying? What will you be identifying? The first step in a risk audit should be to identify what the risks are in a particular situation. So that's the first thing you need to do. You need to assess the risk. Now, when we say assess the risk, what do we mean? You assess the risk on 2 fronts. You assess the risk probability and you assess the risk impact. That's what we mean by assessment of risk. That's what we do. I have review. The auditor should look at the controls that are in place and see whether those controls are able to manage the risk when an adverse event occurs. That's review. And the review, you are trying to monitor and control stuff or check that everything is okay. Then report. The risk audit should lead to a report to the board of directors or to management. Risk issues must not be kept in secrecy. It must be reported. Now let's look at enterprise risk management. What is enterprise risk management? Any ideas? What is enterprise risk management, please? Oh, please, it doesn't have to be correct. Any clue, any idea? I'm waiting on. Hey, is everyone there or people are not there? Okay. No one wants to talk. So the board must always ensure that there's a robust framework for risk management. Many companies have established an enterprise-wide risk management framework so that the approach to risk management is consistent through the company. So when we talk about enterprise risk management, I'm surprised I didn't even put a definition here, but when we say enterprise risk management, it's quite simple, right? When we say enterprise risk management, it's basically the strategies, the methods or the processes that organizations use to manage risk and take advantage of opportunities that will help them achieve their objectives. So we've already explained risk management. We know what enterprise is. So that's why I was asking if anyone had a clue. Nothing more, nothing less. I hope that's clear. Okay. A risk can be defined as any event or blah, blah, blah. We've already talked about that. Now, let's look at this 3-level framework when it comes to risk. First of all, you need to establish the approach to risk management. Second, you need to commit resources to risk management and ensure that the infrastructure you've put in place to manage risk is in place. Then you need to implement systems. So ECI, establish the approach, you commit resources, and implement systems for risk assessment. Very key. Any questions on that? Any questions on that? Hey, can you hear me, or is it that you cannot hear me?
Oh, we can hear you, sir.
Oh, okay. Now let's move on to, there's something small I wanted to discuss on financial management. So let's do that quickly and see if we can do a page, maybe a page of analysis, and then we move on. No, I think that case would leave it. But I wanted you to, when we get there, I'll just explain it. So let's look at sources of finance, right? Sources. An important aspect of financial management is the choice of methods, that are used to finance a company's assets. Companies use a variety of sources of finance, and the aim should be to achieve an efficient capital structure that provides all these things here, right? When we talk about short-term finance, companies can use short-term finance and long-term finance, right? And you must understand the situation of the company so that you can recommend to them. I'm discussing this because sometimes organizations will lack capital and you need to know what to recommend to them. The usual sources of short-term finance are overdrafts, short-term bank loans, and even sometimes trade payables. You have also long-term finance. Long-term finance. Long-term finance could be equity finance, debt capital, lease finance. All these things, different situations require different forms of finance. Okay. Equity finance. What is equity finance? I hope you all know what equity finance is. It's finance provided by the owners of a company, its ordinary shareholders or its equity shareholders. You can raise new equity finance by issuing new shares. Issuing new shares. So anytime you face a case where they are telling you about financing, always try to differentiate between short-term finance and long-term finance and know which would be a better fit for the company, right? In the case we looked at the last time, they were considering options. And in those considerations, if you've understood your sources of finance properly, you can recommend an appropriate source of finance for them. Now, case study. Case study. There's this case, I can't remember the year though, but I think these are the people in the case, Adolfo Boateng and Kofi Oduro. They met at a university in the USA. I can't remember the year. So this particular case, right? I wish I could find the year. Can someone help me find the year for this case? I can't remember. Should have gotten it. But the names there are Adolfo Boateng and Kofi Oduro. It's at the beginning, so you will see it. Now, I'm going to give you this case as an assignment. And all you need to focus on is the pre-scene material. I need you to prepare an analysis. I hope you are with me. Is everyone hearing?
Yes, please.
Yes. The case, I can't remember the year, so you would have to go through. I'm giving you 2 weeks to do this. So not next week. I'm not taking next week, but I'll take it on, God willing, on the 20th. So go through this case, raise the issues, only the pre-scene material, talk about the issues. It should be in a Word document. Otherwise, I cannot see your handwriting. It should be in a Word document where you've typed it. And then, if it's difficult to type, you can write it and scan it to me. But I think that's more complicated. So you can type it in Word and just, hey, somebody has a question? Okay, November 2019, fantastic. That is November 2019. So please that one, I'll take it next 2 weeks. I hope next 2 weeks is okay.
Sure.
Yeah, so I'll take it next 2 weeks. You can just send it to my email. My email is, where is it? I need to send it in the chat. This is my email. You can't send it through email. You can send it. You can also send it to my WhatsApp. Any which way, it should be able to work. It should be able to work. So since we have like 15 minutes, let me see if I can find that other case. Can you see my screen?
Yes, sir.
Okay. So I don't know where we got to the other time. I can't remember. If someone can remind me, that would be amazing. I can't remember where we got to the last time. I think we got to, I think we did this. Yeah, we probably got here. I don't know. I can't remember. So if someone can start reading, at least we can do a page. We can do a page and then move on, Maybe touch on a few things and then boom. So someone can read from Customer Focus Limited, Performance and Position. Can someone help us read, please?
The development of supermarkets in Ghana over 30 years ago coincided with the growth of incomes and the increase in purchasing power. International food retail chains launched branches in Ghana, such as ShopRite, which is South African owned, alongside the rapid development of homegrown stores and chains, such as Maxmart. The building of new shopping malls across Accra and elsewhere altered the pattern of shopping and changed expectations about what was demanded from store retailers in terms of the range of products offered and the convenience of the shopping experience. For example, one key aspect of Qualys' positioning is to make available a diversity of products. There are other examples concerning differing commercial approaches to food retail, such as a substantial online presence, for example, Malcolm, to the very larger hypermarket run by Palace Hypermarket.
Fantastic. So here, the case is giving us some context, right? As to the kind of people Customer Focus Limited is competing with, right? So it's telling us that, telling us the kind of people they are competing with and the factors that influence greatly this industry. Very, very key. It's talking about the fact that they are international food retail chains. So international food retail chains is talking about, it's not just for fun because it shows that the fact that an international person is coming from somewhere to your country to come set up a business shows that there's opportunity. But everywhere there's opportunity, there's also competition. There's also competition. So that's where we see it's giving us a competitive landscape in terms of the food retail space. So that's one thing that we see here. And another thing that this paragraph shows us is how these organizations or these stores position themselves in the market, right? How they position themselves in the market. And it says for Koala, it positions itself by making available a diversity of products. So if you enter Koala, you should get everything. Everything. So that's how it positions itself. So the question is, how has Customer Focus Limited positioned itself, or how best can they position itself? When I look at this company very, very well, and I look at the existing trends towards online space and deliveries and all that, so far as we've read the case, we haven't seen anyone take control of the online territory. We haven't seen much of that. In the digital marketing, e-commerce space, we haven't seen much of that. Everything so far seems to be done a bit traditionally. So this is a place where Customer Focus Limited can position themselves to gain competitive advantage over their rivals. And by the way, the paragraph also used a term called hypermarket. A hypermarket is an extremely big supermarket. That's why it's called hyper. It's very, very large. It's very, very large. It says there are other examples concerning different commercial approaches to food retail, such as a substantial online presence. Oh, okay. So Melcom, in this case, has a substantial online presence. So basically, Customer Focus Limited must find a voice in the market. If Koala is known for diversity of products, and Melcom seems to have a substantial online presence, who is actually into e-commerce and e-deliveries, delivery of food stuff? We haven't seen anyone yet. And so, basically, that's what the paragraph is talking about. There was a document I promised to send. I don't know if I sent it though, where I summarized all the models. I'm not sure if I sent it.
Yes, please,
Yes,
you did.
Oh, okay. I see. Okay, next paragraph. So when it goes off, we are not rejoining again, just so you know. So can someone read the next paragraph so we move on quickly, please?
In this context, Customer Focus Limited began trading on 1st January 2017. Initial capital was created with 100,000 ordinary shares, and the share capital amounted to 300,000 Ghana cedis. The shares were owned in the proportions: Pakpo Ama 70%, Akwesi Boateng 20%, Mary Akwa 10%. Debt capital was also introduced. Customer Focus Limited raised loan finance of 100,000, which was repayable in full after 5 years, unless renewed, subject to negotiation. The loan carried a variable interest charge, which was reviewed on the anniversary of taking out the loan. The loan carried a range of covenants associated with it, and these are detailed below in the summary loan documentation. Customer Focus Limited leased premises in Ghana. The lease agreement required the company to pay a rental at the start of each year, and the high expense of the agreement reflected the store's proximity to one of Accra's leading malls. The lease agreement was to run for 5 years with the possibility of renewal.
Fantastic. So here is setting up, the financing thing we talked about. And that's why I had to touch on it briefly. So here you have debt and you have equity, right? Equity is 300,000. It tells us the proportions, So it seems like Paco has a lot of say. The one who has a lot of money has a lot of say. And debt is 100,000. So when you look at it from a gearing standpoint, which is your debt over your debt plus equity, it means that your gearing ratio would be about 25%, if I'm not mistaken. The only problem we see here is that after 5 years, is the variable interest charge, sorry, is a variable interest charge. It means that, what it means is that the interest rates will go up. There's a risk that the interest rate will go up, and that's a problem, right? Because when you have a variable interest charge, banks have the laxity to change the interest rate depending on the economic circumstances going on. So that's one of the huge problems. And also the covenants, the debt covenants. The debt covenants basically will place restrictions on Customer Focus Limited. So there are things like they'll require them to have a minimum cash balance. Basically when you go for debts, there are usually strings attached. And so that's the problem. Another thing that is talked about here is the lease, and the high expense of the lease. One of the things that is interesting to note as we read through the case is how the lease is treated. The lease agreement is expensive, so it impacts the financial statements of Customer Focus Limited very, very much, very, very much. There's a lot more to talk about, but we have to run through quickly. Initially, I said when it goes off, don't come on, but when it goes off, please come on again. We have to do some quick 5 minutes and then we are done. Or quick 5-10 minutes and then we are done. Okay, let's continue.
The leased unit size was sufficient for Customer Focus Limited to offer a range of goods to attract high-spending customers who prioritized convenience over price. All the initial funding was spent on creating product lines in sufficient quantity to attract these customers. Additionally, the store unit required a substantial amount to be spent on refitting and purchasing of refrigeration units and cash desks that were capable of maintaining inventory records and of using loyalty cards.
Okay, so if you remember, who was the one using the loss leader technique? The
organization.
Sorry?
I think it was Customer Focus that you were using the loss leader.
Okay. The contradiction here for me is that it says the lease unit size was sufficient for Customer Focus Limited to offer a range of goods to attract high-spending customers who prioritize convenience over price. So for these people, price is not their main thing, it's rather convenience. But I guess Customer Focus Limited, so I'm just wondering why they went for the loss leader pricing strategy, like selling at a loss. But probably it was because they wanted to enter into the market. So should they be thinking of revision of their pricing strategy at this point? That's something that stood out for me. It says all the initial funding was spent on creating product lines in sufficient quantity to attract these customers. Obviously product range is very, very important when you're operating a store, because you don't want someone to be walking into your store and then leaving. Additionally, the store unit requires substantial amounts to be spent on refitting, blah, blah, blah. Okay, let's move on to the next paragraph.
The owner's forecast profitability from the onset and had, the owners forecast profitability from the onset and had initially carried out an investment appraisal that indicated that the store would make money over a 5-year period. There was an expectation that the business would continue after the 5-year period, but only after a substantial appraisal was undertaken shortly before that time about whether the business was likely to be viable in the longer term. Discussions had taken place at the beginning concerning how the owners would exit the business should they wish to dispose of their investment in 5 years. The owners agreed that they would not take any dividends out of the business.
Okay, so first off, once you hear forecasts, you need to understand the assumptions surrounding the forecast. The assumptions surrounding the forecast will influence the accuracy of the forecast. And two, the factors that were existing at the time of the preparation of the forecast might have changed. And so that would impact the accuracy of the forecast as well. And forecasts are supposed to be monitored because there are constant environmental changes, especially if you're operating in a turbulent environment. And so we need to understand what kind of assumptions were put into this forecast, right? What kind of assumptions were put into this forecast? One of the things that they are looking to do is that whether they would continue with this investment or not, continue with this investment or not. The last sentence brought some bit of hope where they are talking about them not taking any dividends, but reinvesting them back into the business. Okay, let's go on to the next thing.
Summary loan documentation agreement between Customer Focus Limited and Accra Business Bank. Loan amount 100,000 Ghana cedis. Interest rate standard variable rate of Accra Business Bank. Repayable in full 31st December 2021. Security fixed charge on personal property of signatories. Conditions. Customer Focus Limited agrees to meet the following as a condition of the loan. 1. Repayment interest rates, repayment schedules, and final date of repayment can be altered by ABB if covenants are not met. 2. Customer Focus Limited agrees to maintain the following covenant. To maintain monthly cash balances sufficient to pay the following month's interest payment. To maintain net working capital always at a positive amount defined as inventories plus receivables less payables.